You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Adam Hamilton, CEO of ZealLLC.com. Welcome to the show, Adam.
Hey, Jim. Thanks so much for having me. Great to see you.
Looks like the luster is off gold big time.
Oh, my gosh. It's been a tough slog the past couple of years, several years for contrarian investors like me. And today is one of the darker days in that long kind of death march feeling slog through these markets. Last night, when it was about 9:30 p.m. Eastern Time, Sunday night, there was a sharp sell-off in the gold market, gold futures markets. It was really weird. It was a flash crash type scenario, Jim. Totally strange, totally irrational, totally odd. Someone sold $2.7 billion in notional value worth of gold futures in less than 2 minutes at 9:30 p.m. Eastern. And, there's no way that's like normal selling. If you actually own gold or if you own long gold futures, you don't want to shoot yourself in the foot by destroying the price you're going to get for it. The only logical scenario for dumping so much gold so fast is if a short wants to go stop hunting, just break through all the stops all at once. It was a really liquid time in the markets. No one was around, no one was watching. The Chinese stock markets were just starting to open, and to dump that much gold in such a short period of time just destroyed the metal. Dropped about $50 to $10.86 at worst. It's recovered about $20 today, but still, it achieved its objective of just destroying sentiment. I mean, sentiment in gold has been really poor, even miserable for months now, if not years. But people are so morose today. So much capitulation. Everybody thinks gold's going to go under 1,000, under 800, under 500, depending on who you talk to. And so this sell-off, right, a major low, was really pivotal psychologically, really irritating, really vexing for the guys who think that gold's undervalued, like myself.
Do we have any idea who did the sell-off?
There's always the usual suspects. I've been writing publicly on this for 15 years, and there's been conspiracy theories the entire time. Back in the early 2000s, when gold was at 250, people talked about central banks holding the gold price down. That talk's existed the entire 15 years since. U.S. government's suspect. If gold rises, it makes everything the government's doing look worse. It makes inflation look higher. It makes the dollar look weaker. It makes the stock markets look faker. So I don't know. The usual suspects. The conspiracy theorists don't really define who they are, so they usually call them they, quote, they, unquote. And so, there's a lot of people bearish on gold. It could have been as simple as a hedge fund. If you had a hedge fund and you could short lots of gold futures fast, why not take the chance? Gold was at a major low. Sentiment was horrible after Friday, and they picked a really weak time and just hammered gold. So my best guess is a hedge fund, high-frequency trader. I don't think it was official, just based on a little bit I know at this point. But, more information will come out in this. There was another flash crash like this, Jim, back in January 2014. And the U.S. Commodities Futures Trading Commission looked into it. Gold just collapsed because of an unusual sell order that just hit incredibly fast, way beyond normal scenarios. And the company involved in it was a little futures trading company, and several of their customers use them to just hammer concerted sell orders in the gold futures. And the Commodities Futures Trading Commission actually disciplined this little company. I think it was called Mirus Futures for allowing this. So I suspect it's a high-frequency trader hedge fund, someone trying to run the stops on gold. It's just a perfect time when everybody was so negative about it. One more thing that's kind of interesting about this is, I think it was earlier this month, Jim, you probably know this, you probably know the date in this, the U.S. futures trading pits closed for gold. So there's not really a defined trading day in the U.S. markets anymore for gold futures, yet American gold futures are still the preeminent world trading venue for gold. That's where price discovery happens. That's what the physical market prices off of, unfortunately. So rather than have this, 6.5 hour period during the day when Americans are up and trading, now the gold market opens at 6 p.m. in the evening, and it doesn't close until 5:15 p.m. the next day. It's like 23-hour and 15-minute trading days. And so there's pretty significant opportunities to affect liquidity if you decide to do big buy or sell orders, and most people aren't paying attention. And Sunday night at 9:30 p.m., who's watching the markets as far as big players go? Not many people unless you're in Asia. So it's a really weird situation, really unfortunate. But I think it'll reverse too. One thing I've been studying is there's been just record shorting in gold futures lately. They just hit an all-time high. The speculator shorts on the COMEX, they're up around. 179,000 contracts. And each contract represents 120 ounces of gold. This is just an incredible amount of gold shorted. Never before in the history have we seen that much gold shorted. And the great thing about lows driven by shorting, Jim, of course, is that the shorts have to buy back those contracts. They borrow gold futures to sell them in the open market, but they're legally and contractually obligated to buy back those same gold futures they borrowed and sold in the near future. And the leverage in these contracts is just extreme. Last week when gold was trading at around 1150, a 100-ounce contract would control $115,000 worth of the metal. But you only had to have $3,750 of margin in your account to control that much gold. So it's like around 33 times leverage. And so if these guys are wrong by 3%, if gold rallies by 3%, they stand to lose 100% of their capital risk if they're at maximum leverage, minimum margin. And so since this was a shorting-driven low, it should be transitory. It should bounce back fast. Over the past couple of years, since 2013, we've seen, I think 4 major lows. This would be the 5th that were driven by future shorting on the American exchanges. And gold rallied sharply out of those, like an average of 16% in 10 weeks. Because those future shorts have to buy back their gold to sell them. It's not like when people actually own gold, sell it, they have no obligation to buy it back. When you borrow it to sell it in the futures markets, you have to buy it back. And so it's guaranteed near future buying. Well,
you said 9:30 on a Sunday night, only China was open. Don't forget, China has been buying every scrap of gold they can find for the last 3.5-4 years. If they went and sold off a huge hunk and dropped the price, they could buy it back at a lower cost.
Absolutely, that's a really good point. There's some people who think there's some tie with China. Last week, the Chinese central bank made an interesting announcement. They said they finally increased their gold holdings by like 57% from the last update. And I don't know this exact date, but say 2009 was the last time the People's Bank of China updated their official gold holdings. And so last week they updated that, but it was disappointing to Western investors because we all thought that the Chinese central bank would have vastly more gold than it reported. And so that kind of put the negative gold psychology into play that happened late last week and kind of spilled over into Sunday night. But a really interesting thing, Jim, is that moments before this gold futures sell-off, and it was in the American markets, not the Chinese markets, by the way, U.S. futures markets trading 23.25 hours a day. It could have been Chinese sellers, but it happened in the American markets, the definitive gold markets. Moments before this happened, the People's Bank of China came out and revised that number they released last week. They only changed it by like 0.1 by 1 decimal place, but it's kind of interesting that they didn't get that number accurate in the first place. Why did they change it? What was the motivation of that? Everybody thinks that number's made up. Everybody thinks the Chinese government has vastly more gold than it's reporting. So I don't know if there's a link between that, but temporarily there certainly was a close relationship between that flash crash last night and the revision by the People's Bank of China, a slight revision. So I don't know, man. It's crazy. It's weird. It's less than 24 hours afterwards. I'm still trying to digest it myself and dig up whatever information I can about it.
What has this done to the price of silver?
Silver's always been slave to gold. I've written extensively about that. And so you would think silver would plunge too. Gold's down like 4% at worst. And so silver generally leverages the gold's price or amplifies the gold's price by like 2 times, sometimes 3 times. So you'd think it'd be an 8% down day in silver. But rather amazingly, silver is just down fractionally, like a third of 1% in the middle of the U.S. trading day. And that's really interesting. That suggests that there's major, huge selling exhaustion that's been hit in silver. And the silver futures shorts on American exchanges actually hit an all-time record high last week as well, way up around 81,000 contracts, I believe. Never before have they been anywhere close to that. And so, you'd think everybody who's sold silver, who wants to sell silver, has sold it by now. The speculators are so short that metal, it's silly, and they've just got enormous buying to do in the near future. There's been short covering rallies in silver in the past couple of years as well, even in this miserable sentiment environment. So silver's resiliency is really interesting. It really implies selling exhaustion in silver. And silver is kind of a sentiment indicator for gold too, since it follows gold so much. So I think that's another indication this bottom should be transitory and very short-lived. There's going to have to be huge future short covering on both the gold and silver side, and that should propel those metals up fast.
We'll have more with Adam Hamilton right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Adam Hamilton. Adam, what's going to happen to other commodities besides the precious metals, or what is happening with them?
Well, we live in such a strange era. It's like a fantasy land, Jim. It's so wrong, for lack of a better word. Like everybody believes that stock markets rise forever, that there's no material sell-offs anymore. everyone believes that because central banks are behind stock markets effectively all over the world, that stock markets will just keep rising and rising and rising. And therefore, there's this belief that portfolio diversification is no longer essential. If stock markets are going to do nothing but rise because central banks are printing money to effectively prop up stock markets, why own anything but stocks is how the reasoning goes. And therefore, people don't want to diversify their portfolios. They don't want to invest in commodities at all. But this is a huge problem in all kinds of levels. Markets are forever cyclical. It's greed and fear, herd behavior that drives stock market cycles. It has all throughout history. It will all throughout the rest of history. And this notion that stock market cycles have been nullified just seems so silly. The Chinese central bank was absolutely the most powerful in the world locally in its own market, and it couldn't arrest, that bubble bursting over in China last month. The Chinese investors lost a third of their wealth in less than a month. And there's just every single example in history of central banks trying to manipulate markets ends in failure. They can delay market cycles, but in the end, the market cycles are going to come and they're just going to be amplified by whatever delay factor the central banks artificially put into them. So commodities are all suffering right now because people believe that portfolio diversification isn't necessary and therefore they shouldn't put any capital into anything but stocks. But all stocks are correlated to the big indexes like the U.S. S&P 500. So once that thing rolls over, everything's going to sell off with it. And I think only at that point are investors going to think, wow, I should diversify my portfolio again. Maybe I should invest in gold, silver, commodity stocks, oil producers, something that makes physical assets rather than just these paper stocks buoyed by central bank money printing. So everything's just really weak until this weird stock market topping sentiment passes, and it will. It always does.
Do you think sometimes when you have a market that's lasted this long, the brokers themselves are so young they haven't seen anything else?
Man, that's a great point. I think about that often. I have a lot of friends and acquaintances in the money management industry, and I talk to them, quite a bit, and just hear their thoughts about it. People don't remember what market cycles are like. Most people don't remember what the 2007 top was like, and that wasn't that long ago. And we're talking 8 years ago. That's not a long span in the grand scheme of things. The last top before that was 2000. That gets a little bit farther back, 15 years. You figure the average investor has say 40-year investing lifespan from the age of 25 when he can start running a surplus to 65 when he retires. And these market cycles aren't evident to people because they just don't have the proper perspective. And I think that's one of the reasons why studying the markets is so important, because the markets go up, they go down, they have these cycles all throughout time, but the cycles move slowly enough that unless you have that benefit of historical perspective, you just won't understand them. And I know you're a student of history, Jim, and you appreciate that for political market reasons. And people just lack that perspective, and therefore they're probably going to be really frightened when this next market cycle inevitably arrives.
Well, most people can't remember who they voted for last time.
It's terrible, man. In the newsletter industry, it's kind of funny because people don't remember anything beyond like a week or two ago regarding your trades, regarding the markets, regarding stuff you said, and so it's incredible. It's really challenging. You're trying to help advise people, help them try to make wise decisions for 5-10 years in the future when most people just can't think beyond a couple weeks ago in financial market terms.
Any thoughts on crude?
It goes back to that whole commodities are useless thing because the stock market's going to rally forever. I think oil will rally once people realize that paper assets are not the only thing that should be held. Oil is more problematic than gold because gold will go up when stock markets go down. There's historically a strong inverse correlation, but unfortunately there's a strong positive correlation between the stock markets and oil. So I kind of worry about what will happen when the stock markets roll over to oil. But on the other hand, oil's been hit so hard in the past 9 months that most of the sellers should be out. It's just when something falls by half or more, everybody susceptible to being scared into selling is pretty much already sold. And so oil might be a lot more resilient during this coming stock market sell-off than it would be otherwise. And gold might move oil up too. As gold starts rising again, people might want to look at other commodities, but it's just hard to diversify into oil, and so investment buying in oil is more challenging. It's a lot more expensive to store oil. You can buy the oil stocks, of course, but the actual commodity itself is more difficult to invest in, more expensive.
Adam, anything else you wanted to throw in on what's been a pretty gloomy time for gold?
I've been doing this for a long time, Jim. I've been professionally writing newsletters since early 2000. Back when I started, gold was in the 250s, and everybody said it was never going to rally again. Everybody said that central banks had total control. They had so much gold that they could sell it from now to the end of time, and gold would never rally. People thought you were just insane for investing in gold stocks back in the early 2000s. They were the most hated sector on the planet as they are today. Yet cycles change, attitudes change. Gold went from 250 to 1900. The gold stocks went up by 16, 17 times by their leading index. Markets are ever cyclical. the time to sell is not when it feels the worst, like right now. It's time to buy. I realize a lot of people are already deployed, as are we, and we've been stopped out of just tons of stuff the past couple of days, but that's the way the markets go. But I just encourage people to take a long-term perspective and realize that extreme greed and extreme fear never last. People aren't going to be scared of gold forever. This despair isn't going to last. This low is artificial. It's driven by extreme shorting, and these shorts have to be covered very soon. And the stock markets can't rise forever. People felt that way in 2007 and 2000, yet the market still topped and rolled over into 50% bear markets. And so I just encourage people to take a long-term perspective and not get too worked up into what's happened the last couple trading days.
Adam, thank you very much for chatting with us.
Thanks for having me, Jim. Hopefully next time we talk, we'll have a gold rally in our hands that we can celebrate.
My guest has been Adam Hamilton, CEO of ZealLLC.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.